Hello guys, welcome to this video. In the last video, we had concluded say like how to identify and spot the imbalance and balance phases of the market. That's what we identified. And in this video, we are going to discuss how actually we trade the imbalance phase of the market. Right? That's what is the agenda of this video. And as already you know, the imbalance is nothing but a single print and range extension. That's what an imbalance looks like on a market profile graphic, right? So now, like before trading the imbalance or like this particular video, I have divided it into like three considerations that we have that we should be taking care of when trading an imbalance, right? So the first thing that we do as part of this consideration is we keep track of strength of the imbalance, right? That's what the first thing that we have to do. And the next thing that we do is that we take care about is the entry price that we would be entering and the position size that we would be entering at a particular point of price. So that is the next point of consideration on trading an imbalance day, right? So the next point is that giving the market time to take out weak hands. So this is something where the test size and full size are applied at different points, right? Different price points when the market has some task, like the market is having some task to take out some weak hands, right? That is one thing that that is the consideration that we have for an imbalanced day, right? So going into these three considerations in detail, the first thing that we want to do is discuss about how do you track the strength of the imbalance, right? The imbalance, as you already know, imbalance is nothing but a single print or the range extension. So we evaluate the strength of that imbalance through the demand and supply forces, right? So on the OI analytics tool, so if you see one-sided build-ups which are more than the thresholds that are mentioned in the volume video, if you see those one-sided build-ups happening, right, um, in that imbalance price zone, then that imbalance is said to be good, of a good strength, right? Of a good strength. At least two consecutive big quantities if they are coming, or even one quantity which is coming with a very big size, right? That is something which signifies the strength of that imbalance, right? And you should not see something different, right? You should not see something which says within that imbalance zone we had contradicting positions, right? So we should not have that case. So in which case the that imbalance strength will be very less, right? Because there is no one-sided activity; it is a two-sided activity that has been seen in that imbalance price zone, and you could expect that imbalance zone not to hold, right? So that's when you avoid trading on that imbalance zone, right? So if there are contradicting positions within that imbalance, so here I mean contradicting positions as in one long and one short. I don't mean something which is something which is different as in, see, for example, you see an imbalance which is a buying imbalance on the market profile graphic, but you see completely one-sided short build-ups happening on the OA tool, then I don't call that as contradicting positions, because that is one-sided positions. Even though it's contradicting to the imbalance of the market profile graphic, it's not something contradicting positions. It's a one-sided positions, right? So in that case, what we should do is, so we should also take it in similar terms that the imbalance is of strength, because what happens in those cases is that the imbalance formed by the market is buying imbalance, but that imbalance is formed from trapping a lot of quantity which is on the opposite side, right? So that is also considered to be one of the significant strength of the market, right? So in those one-sided positions, irrespective of the side which that build-up is taking, so you would be taking the side of the imbalance that formed in the market profile graphic. But only thing that needs to be there is the one-sided build-ups should be there instead of contradicting positions, right? So this is one key thing, right? So if contradicting positions are there, so you would expect that later in the day this imbalance zone will be tested and there will be a balance in that zone. That is what you should be expecting, and you should not be applying these rules of trading imbalance to that particular day, right? So maybe initially you would see some imbalance, single prints, etc., but later in the day they would be filled because there are contradicting positions over there. That's what you should expect, and that expectation will change only when there is a range extension that happens, because that is the fresh imbalance that occurs. And if that happens with good quantity, then you would trade that as an imbalance day, right? Not expecting the balance to again occur, right? Only if the range extension happens with very good big build-ups, right? And this is how you test the strength of the imbalance. The only factor that you want to test the strength of the imbalance is, in the single prints you should have one-sided activity. It's not a two-sided activity, it's a one-sided activity, and only within the single prints. Above the single prints it could be something else, but only within the single prints if you should have a one-sided activity, right? And on and one more thing that you would also keep track is that, so whenever the market price is coming and testing that imbalance, so you should not see a big opposing force that is coming and driving that move within the singles. So within the singles you should not see some fresh built up of an opposing force. By that I mean, if there is a buying imbalance, the market comes back to buy that buying imbalance, and immediately you see a sudden big seller popping up within that buying imbalance, right? That is when the tide is turning very big, right? That's when the tide turns very big, and the opposite movements happens very quickly, right? At that moment also you would not be taking previous imbalance to be valid, because there is some big opposing force coming, and you would wait to see what that guy is up to, right? You would wait to see what that guy is up to, and if he is making a range extension below that imbalance, below those single prints whatever are there, if he is making a range extension you would go with that imbalance, right? Again, right? So that's a fresh imbalance. So that's what we do. We You should not see any big opposing force that is coming whenever the price is testing there, right? And you can maybe have exits, right? The unwinding happening, which indicates that weak hands are getting out of the market over there within the single prints, that you can see around the price zone of singles, that you can see that activity. And when you see that activity, it becomes a very good probable entry, very high probable entry, because that's when everybody is not believing that, everybody is exiting their position believing that the move is not going to come, but that's when the move comes, right? That is one important thing. And that also you should be having an eye on, right? So this is how you evaluate the strength of the imbalance. So the next point is the entry price. So where should be my entry, right? So the price always, if there is a single print area, you should be looking to enter near those single print area. That is the first point, right? The second point, in the range extension, whenever so you didn't get an entry in the single print, you only have a range extension which you have to enter on, then you would be entering at the average price of the quantity which drove that extension, right? So if there is 100,000 quantity in nifty which has been sold and which has caused this range extension, so you would be looking to enter at the average entry price of that 100k quantity, right? That is what you do on a range extension, right? And so if there is a single print followed by range extension, the odds of that going uh, going positive is high, right? And if there is no such single prints at the top, but still you get a range extension handle, so what you do is you just enter 50% of your size at the entry price of that extension handle, and rest of the 50% you would look to enter a demand or supply zone within the IB, right? That's what you do. So when there is single print, you go with full quantity of the 100% at the entry price of that extension handle, right? And when that doesn't happen, what you do is you only enter 50% of it there, and rest of the 50% you would be wanting to enter somewhere within the IB. If it is a long upside range extension, you would be entering the rest of the quantity within the IB near some demand zone, because the range extension is to the upside, and vice versa, you would be entering at a supply zone if the range extension is to the downside. So this is how you would be entering a particular imbalance day. On any given day, these are the only price points you would be looking to enter. and if you are not getting these price points, you don't enter. This is a simple rule, and if you follow this, you will be good off. Otherwise, there is a the chance of hitting a stop loss is very high. Right now, the entry price is what we have discussed. Right. So where should be my stop loss? Right. The stop loss would be the in case of single prints, the flag end of that single prints, the tick below that single print area. Right. That is the stop loss that you would be having. Right. And in case of range extension, so you would be having the IBH or IBL to be the so for example, if you are entering a range extension down, if you are entering a range extension down at the IBL, because the range extension of down happens at IBL, so you would be entering somewhere over there, right? So your stop loss would be IBH, right? So if it is very wide, if it is very wide, the IBH and IBL range, then you would have to put your stop loss nearest the biggest supply zone that is there. The biggest supply zone that is there within the IB, that is where you will want to put your stop loss, right? And similarly, supply or demand zone. I mean, like in case of a long trade, you would be putting a price which is below the demand zone within the IB, right? But the extension should be driven by heavy volumes in that case, right? So that is one thing. That's where you put your stop losses below the single prints or IBH or IBL, or if the IBH or IBL are very wide, then you put somewhere in the demand and supply zones based on the data that is there, right? That's what you do for the entry price and the stop loss. Now comes the portion of the price target, right? So the price target is the so if you're entering at single print area or anywhere, like anywhere you are entering, the target on an imbalance day, if the IB range is wide, right? If the IB range is wide enough, then you would have to expect 1 to 1.5 times the IB range to be your target for the day, right? In the direction of the trend, right? If the IB range is 70, then you would expect a 70-point movement either side the IB. That is your target, right? A conservative target. And if the IB range is narrow, right? If the IB range is narrow, then you would get 2 to 3 times the IB as your target, right? So that is the targets in terms of the profiles, right? And yeah, so this is about entry, stop loss, and targets that you would be looking for, right? So then there is this important concept of weak hands exit concept, right? So why do we use this concept is that, so this is nothing but a stop loss hunts that happen in the market, and these hunts only take out the weak hands, right? So this is when there is a very high probable entry, and it will be around these prices that I mentioned in this slide, around the single print, around the extension, and stuff like that. But when these things happen, when the exit weak hands are exiting, you would be having a perfect high probable trade. So that's why what we do is, when we are testing for the strength of the imbalance, we see one-sided build-ups, right? So we see one-sided build-ups, and there could be some a small accompanying size which is opposing to that one-sided build-ups. Immediately after those one-sided build-ups, you would see an opposing size to that. So though it might be a big or not big, I mean, like it might be above thresholds or not, but what happens is that it accompanies those one-sided build-ups immediately after that. So that quantity is actually taken by the smart money to uh, like to exit at the opposite end when the weak hands are exiting. Let's say in the opening 30 minutes or in the opening 20 minutes, they have taken 400,000 of nifty longs, right? And in the other 10 minutes out of the 30 minutes, in the 20 minutes they have taken 400,000 of longs, right? In the other 10 minutes, what they would do is they would take like 100, 120,000 of shorts, right? So in this case also, it's still one-sided, because so if you sum up all this, so you would still have a dominating one-sided build-ups are on the long side, because 400 is the long and 100 to 120 is the range of the short. So though it's big, the size of that short is big. It's not to be taken as a contradicting position. Only it has to be taken as a contradicting if it's equal in size and it's like not dominating on the one side, right? So that accompanying quantity, wherever whichever they have entered, usually they enter it for exiting when the weak hands are exiting. So when you see that quantity exiting, that becomes your perfect entry, right? So that's why we take this concept of weak hands exit. And when weak hands, those quantities are exiting, you would take your size to the fullest quantity and you would go aggressive, right, with the stop loss of the same stop loss which are mentioned here. So that's what it is. So whenever you have such accompanying shorts or longs which are accompanying those one-sided build-ups, so and the market is not really in a hurry and visiting back those singles, and whenever it is visiting back those singles, then you would see that accompanying activity exiting, that becomes your perfect entry. That is why this also is very important when you are looking for an entry near these price zones. uh, Near these price zones, whenever you are looking for entry, also keep an eye on the weak hands exit. So if that is happening, then that would become the perfect trade entry, and your stop loss hitting possibility is very less in these particular case, right? That is one important thing has to be kept in mind. So this applies for the balance days also, but I wanted to specifically point this in the imbalance days because there's a good trend that is gonna come, right? So this is one important concept that you have to also keep in mind along with these prices, where you should be entering the trade, right? So this is how you trade an imbalance day. So I've mentioned the entry price, I've mentioned the stop loss, I've mentioned the target, and I've also mentioned when your stop loss hitting chance will be very less. So when there is a accompanying quantity which exits and weak hands take exit at that place, that's when you would have a very good trending move from that point of time, right? And also I've mentioned about the evaluating the strength of the imbalance by seeing one-sided positions, right? So this is what is the key considerations that we have for trading an imbalance day, right, guys? So in this video, if you have any questions, please post it in the comment section. I would address it. So this is what we have for we trade an imbalance day basically, right? And going by that, I would also like to show the entry locations in the on the graphic itself. So these single prints zones are the zone where we would be entering, and if there is a range extension like this, we would be looking to enter at the extension handle as mentioned like previously in this video, right? That is where these are the 2 points, and in extension, if it is happening with good volume, and if there are no single prints, so if there are no single prints, what we'd be doing is we would be entering 50% here, 50% somewhere within the IB of a demand or supply zone. So in this case, we would be entering 50% here and 50% somewhere in the supply zone within this IB. So if you see this particular day, we had single print, so we could have directly entered the price where this extension, if the quantity was very big. This day I'm not sure if the quantity was big. If it is big, then we enter at the price of that big quantity, right? If it is not, then if the quantity is not big, then that is not an imbalance at all, first of all. So what you would be looking, you would be again looking to enter it somewhere here, right? So only that extension, if it is an imbalance, that means that it is an extension with a very good quantity, right? So that is how we enter the trade, and we put the targets as one time the IB if the range is wide like this, and if the range is like very small, uh, like say for example, where is that example? I can't see any example for a small range. I think it will be there in the spot chart. Yeah. So here you can see the range is very small. So you can expect 2.5 to 3 times the IB on such days, right? When the extension happens with very good volumes. So here this extension didn't happen with good volumes on 30th July. Only this extension happened with good volumes. On such days, what we would be doing is we would be expecting at least 3 times or 2.5 times the IB as a target, right? That's what we do. So this is about the entry, stop loss, target price, and evaluating the strength of the imbalance, and also having an eye on the weak hands exit to take our entry to the fullest size. Right. This is how you trade an imbalance day, guys. Right. So with that, we'll wrap this up, this video, and the next video is going to be on the on trading the balance days, guys. The balance days.